10 Best Small Business Loans for Startups by avibusinesssolutions.com. Cash flow gets tight fast when you are launching company. Inventory needs to be paid for, marketing has to start working, and equipment rarely waits for revenue to catch up. That is why many founders start searching for the best small business loans for startups before they are fully established. The right funding can help you move now, but the wrong loan can drain margin, limit flexibility, and create pressure your business does not need. Startup funding is rarely about finding one perfect product. It is about matching the loan to the stage of the business, your credit profile, how fast you need capital, and what the money will actually do. A restaurant opening its doors has different needs than an e-commerce seller restocking inventory or a contractor buying a truck. How to choose the best small business loans for startups. The biggest mistake new owners make is shopping solely by advertised rate. Rate matters, but so do speed, approval requirements, repayment structure, and loan size. A lower-cost loan that takes months to close may not help if payroll is due next week. Start with 4 questions. How much capital do you need right now? What will the funds be used for? How quickly do you need access? And what can your business realistically afford to repay each month or week? Those answers narrow the field fast. If you have strong personal credit, time in business, and organized financials, you may qualify for lower-cost products. If you are newer, need fast working capital, or have uneven revenue, flexible financing may be the better fit, even if the total cost is higher. For many startups, speed and access are part of their value proposition. 10 Best Small Business Loans for Startups. 1. SBA Microloans. SBA microloans are often a good fit for true startups that need a modest amount of capital. These loans are designed for smaller funding needs and are commonly used for working capital inventory, furniture, fixtures, or equipment. The upside is that they can be more accessible than larger traditional bank loans. The trade-off is that availability depends on participating lenders, paperwork can still take time, and loan amounts may not be enough for capital-heavy businesses. 2. SBA 7 loans. If your startup is farther along and can show a solid plan, an SBA 7A loan may offer strong value. These loans can be used for a wide range of business purposes, including equipment, working capital, expansion, and even the purchase of an existing business. The main benefit is cost. Compared with many fast funding products, SBA loans usually come with lower rates and longer repayment terms. The catch is speed and qualification. Approval tends to be slower, and lenders want to see credit strength, documentation, and a business case that holds up. 3. Business lines of credit. A business line of credit gives startups flexibility rather than a single lump sum. You draw what you need, repay it, and draw again up to the limit. That makes it useful for uneven cash flow, seasonal buying, emergency expenses, or covering short-term operating gaps. For many founders, this is one of the most practical options because it avoids the need to borrow more than necessary. That said, newer businesses may see lower limits and higher costs, especially if revenue history is limited. Still, for businesses that need access beyond a fixed-term loan, a line of credit can be a strong tool. 4. Short-term business loans. Short-term loans are built for speed. They are commonly used by startups that need capital quickly for inventory, repairs, payroll, marketing pushes, or immediate growth opportunities. The approval process is often simpler than with bank products, and funding can move fast. The trade-off is cost and repayment frequency. Many short-term loans come with daily or weekly payments, so they work best when the borrowed money is expected to generate revenue quickly. 5. Equipment financing. If your startup needs machinery, vehicles, kitchen equipment, computers, or specialized tools, equipment financing can make more sense than a general loan. The equipment itself usually helps secure approval, making this option more accessible for newer businesses. This product is best when the purchase directly supports operations and revenue. Is less useful if your biggest need is payroll or general working capital. But if the equipment is essential and expensive, financing it separately can preserve cash for other parts of the launch. 6. Invoice financing. For startups that bill clients and wait to get paid, invoice financing can turn unpaid invoices into usable cash. This can help service businesses, B2B companies, staffing firms, and contractors manage timing gaps without waiting 30, 60, or 90 days. This is not a fit for every startup because you need invoices from creditworthy customers. But when receivables are strong, it can be one of the cleaner ways to smooth out cash flow without taking on a traditional installment loan. 7. Merchant cash advances. A merchant cash advance is not a standard loan, but is often part of the startup funding conversation because it offers fast access to capital. Repayment is usually tied to future card sales or fixed daily withdrawals. This can be useful for retail, restaurant, and service businesses with steady card volume and urgent funding needs. The downside is cost. Is typically one of the more expensive options on the market, so it should be approached carefully and used when speed and revenue potential justify it. 8. Personal loans for business use. Some founders use personal loans to fund an early-stage business, especially before the company has enough revenue or history to qualify on its own. This can work for home-based businesses, solo operators, and lower-cost launches. The benefit is simple underwriting based on personal income and credit. The risk is also simple. You are taking on personal liability. If the business struggles, the debt remains yours. This route can be practical, but it requires discipline and a clear repayment plan. 9. Business credit cards. Business credit cards are often overlooked when people search for the best small business loans for startups, but they can be useful for smaller, recurring expenses. They work well for online advertising, software subscriptions, travel, supplies, and short-term purchases that can be paid down quickly. Cards offer convenience and can help build business credit over time. They are not a good substitute for larger capital needs, and carrying balances can get expensive fast. Used strategically, though, they can be a flexible part of an overall funding setup. 10. Revenue-based financing and online startup loans. Online lenders and alternative financing providers have expanded access for startups that need speed and simpler qualification. These products often focus more on bank activity, monthly revenue, or sales trends than on long operating history. That can be a major advantage for newer businesses that are already generating income. The trade-off is that rates and repayment structures vary widely. This is where comparing offers matters most. Fast approval is valuable, but only if the payments fit your cash flow. What lenders usually look for. Even startup-friendly lenders want signs that the business can repay what it borrows. Personal credit still matters in many cases, especially when the company is new. Revenue matters too, even if your time in business is short. Lenders may also look at bank statements, existing debt, industry type, and whether the funding request makes operational sense. A clear use of funds helps more than many owners realize. If you can explain that the capital will buy inventory with proven turnover, finance equipment tied to booked work, or support a marketing channel with measurable return, your application becomes more credible. How to improve your chances of approval. Get your numbers organized before you apply. That means recent bank statements, revenue records, simple business plan, estimated projections, and clarity on exactly how much funding you need. Borrowing too little can leave you stuck. Borrowing too much can strain the business from the start. It also helps to know your personal credit score and business profile before shopping. If your credit is solid, push for lower-cost options first. If speed is the priority, look at lenders that specialize in quick decisions and practical underwriting. Companies like AVI Business Solutions operate in that space by helping business owners access funding options tailored to real operating needs rather than one-size-fits-all lending. Which startup loan is best for your situation? There is no universal winner. If low cost is the priority and you can wait, SBA-backed options are often the strongest play. If flexibility matters most, a business line of credit stands out. If you need equipment financing is usually cleaner than using general working capital. If time is critical and revenue is already coming in, short-term online funding may be the more realistic move. The right loan should help your business create momentum, not just cover a shortfall. A good funding decision gives you room to operate, invest, and grow without putting daily pressure on every dollar that comes in. When you choose with that standard in mind, financing becomes a tool, not a trap. The smartest next step is not chasing the biggest offer. Is finding the funding that matches how your business actually makes money.
Running a small business means being ready for anything, but what happens when the big banks say no? At AVI Business Solutions, we say yes.